Good morning, everyone. This is Charalambos Pissouros, Senior Analyst at IronFX, bringing you the morning comment for the 27th of January. Trump administration places deregulation at the top of its agenda. The US dollar got a small lift yesterday following comments from Vice President Pence to Republican lawmakers regarding financial deregulation. The Vice President said that dismantling the Dodd-Frank Act that was introduced after the 2008 crisis remains a top priority for the Trump administration, reminding investors that the new government intends to keep its promises. In our opinion, something like that could be positive for the greenback in the short term, as it would lift many compliance and regulatory burdens from banks and other financial institutions, something that could boost growth in the near term. However, one cannot help but wonder whether this would also amplify long-term financial stability risks, considering that many regulators, including Fed Chair Yellen, believe that Dodd-Frank has made the financial system much safer and stronger. Gold traded lower yesterday amid a strengthening dollar and fell below the support now turned into resistance of 1187. In our opinion, the break back below the 1200 hard wall on Wednesday has signaled the completion of a double top formation on the 4-hour chart and turned the short-term outlook negative. Given that President Trump has started fulfilling some of his pre-election promises, we believe that the market may have started gaining back its optimism with regards to his fiscal pledges as well. As such, we expect the greenback to remain supported in coming days, thereby weighing on the precious metal. We would expect the dip below 1187 to carry more bearish extensions and perhaps aim for a first test near the 1170 support territory. Switching to the daily chart, I still see a medium-term downtrend. Following the dip below 1300 on the 4th of October 2016, the price structure has been lower peaks and lower troughs. Furthermore, the latest dip below 1200 on Wednesday confirms that the 23rd of December until the 23rd of January recovery was just a corrective phase and that we are back in the direction of the trend. As for today's events, the first estimate of the US GDP for the fourth quarter is likely to attract market attention. The forecast is for GDP growth to have slowed to 2.1% quarter over quarter from an outstanding 3.5% quarter over quarter in the third quarter. We believe that the forecast may be somewhat too pessimistic and we see the risks surrounding it as skewed to the upside. We base our view on the overall strong retail sales prints throughout the quarter, as well as the fact that the Atlanta Fed GDP Now model forecasts growth at 2.8% quarter over quarter. We also get the nation's durable goods orders for December. Expectations are for the headline rate to have risen, a rebound from the previous month, while the core rate is forecast to have declined, but to remain within the positive territory. The forecasts are supported by the ISM manufacturing PMI for the month, where the new orders index surged notably. Positive US data are likely to add more fuel to the latest dollar rebound. Dollar yen now looks to be headed towards the 115.50 resistance obstacle, where an upside break would signal the completion of a double bottom formation on the 4-hour chart and may bring a short-term trend reversal. Such a break could initially aim for our next resistance of 116.50. As for the bigger picture, the completion of the double bottom may confirm that the recent retreat from 118.60 was just a corrective phase that bottomed near 112.60 and that the prevailing medium-term uptrend is back in force. As for the speakers, UK Prime Minister Theresa May is expected to visit US President Donald Trump at the White House. We think that market focus will be on signals regarding the possibility of a US-UK trade deal. If the two parties send optimistic messages with regards to this prospect, the pound could extend its recent gains. Nevertheless, we maintain the view that despite upbeat short-term signals for the pound, such as the Supreme Court's decision and the likelihood of a US-UK deal, we see further upside in cable as somewhat limited, perhaps near the key resistance zone of 128.50. We think that the bigger story that will probably drive sterling in coming months will be the likelihood of a soft versus hard Brexit. The UK has repeatedly indicated that it wants full control of immigration, while the EU has responded that there cannot be full access to the EU single market without the free movement of people. Unless one of the two sides backs off, we believe that markets may begin to discount an increasingly higher probability of a hard Brexit in the foreseeable future. For more information, please read the full comment on IronFX.com or download our app and get all the information you need to trade. Also, you can follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google Plus to get more trading ideas. This is Charalambos Pissouros, Senior Analyst at IronFX, wishing you solid trading.